this morning on the Ag Issues program. A pleasure, as always, to bring onto the program Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Good to be with you.
And I assume in Jackson County that you got a good chunk of that rain Saturday night?
Yeah, well, extreme northern Shawnee County, but right up near the border. Yeah, 2.3 inches is what I dumped out of the gauge yesterday morning.
And I would say you got that. Yeah, most definitely. All right, let's get to it. And as we mentioned earlier, you recently wrote one of your blog articles about how compressed operating margins and high interest rates are forcing family farms, well, basically to reevaluate their business structure. And you mentioned the standard moves like switching to a greater or a general partnership to an LLC, or so carry tax risk under the OBBBA landscape. What is happening there that you see right now?
Well, for decades, general partnerships have been the traditional setup for farming operations, particularly larger farming operations that can get multiple farm program payment limits. Now, that's another issue we'll come to in a moment because we don't have to worry about that planning setup anymore. But if I move from a general partnership to an LLC, that's usually viewed by producers as completely tax-free. Sometimes their legal counsel, their tax counsel says, you can switch from a general partnership to an LLC, and that's tax-free. It's a non-event because you're keeping the same owners, the same machinery, the same land. But that's not the case. Legally, when you transition to an LLC, the character of the operation's liability, if there is liability, you got to watch this because the character of that liability shifts dramatically under the tax code. So if you mismanage your debt allocations, you've got some severe structural risks that can occur.
Well, let's do this. Walk us through that mechanism and why is a mature family farm at risk during this transition?
Well, a lot of family farming operations, a lot of farming operations in general, from a tax standpoint over time, have prepaid expenses. They've taken fast depreciation. Now we're back to 100% bonus depreciation, so fast write-offs, expense method depreciation, and they've accumulated operating loans. And so what all this means is that many, what I would call mature family farms, have a negative capital account balance in that partnership, and now you're going to switch to an LLC. And so in a general partnership, that negative balance is naturally insulated because every general partner remains personally liable for the entity's debt. But under the tax code, that recourse debt provides the next necessary tax basis to support those negative balances without triggering any gain recognition. But there's a big change if you're going to go to an LLC.
And speaking of change, what changes when they sign the paperwork to become that LLC?
Yeah, here's the catch. When you transition to an LLC, all your debts legally shift from being what we call recourse debt liability to non-recourse by default, unless there are explicit personal guarantees that are executed. And that's the key to the whole thing. So let's say if we have two partners that step up to guarantee a bank loan while a third partner is omitted or is released from that paperwork, that third partner's share of liabilities immediately drops to zero. Well, the IRS views that reduction in the partner's share of debt as a constructive distribution of cash. And so if that constructive distribution of cash exceeds their remaining tax basis, which it almost always does in these farm situations, that excess is treated as immediate taxable gain. That's phantom gain. That is taxed. You didn't get any money in your hand, but you got an income tax bill.
Does that mean then that they could end up owing taxes on money they never actually saw?
That's exactly what that means. And to make matters worse, because those farm assets frequently consist of heavily depreciated machinery, as I mentioned a moment ago, they've probably taken 100% bonus depreciation on it, Section 179. They've dropped that basis significantly. Then that gain does not qualify for preferential long-term capital gain rate. So they get this phantom income, and it's going to be taxed not at capital gain rates, but at ordinary income rates under the depreciation recapture rules. So we always have to make sure that people have sufficient basis that is preserved in these situations through appropriate liability allocations or personal guarantees before that restructuring is completed, or you just get an absolute mess of a tax bill.
All right, so let's then transition to the One Big Beautiful Bill Act, better known as OBBBA. You note that the OBBBA has fundamentally re-engineered how safety net commodity payments are distributed for operation organized as LLCs or S corporations. How did it change the old FSA rules?
Well, historically, FSA enforced very strict adjusted gross income means tests directly at the entity level. And that's why I said earlier that the rule had been if you had any type of entity that limited liability, you got one payment limit because you were assessed on your eligibility at the entity level, and you ignored the owners of that entity, whether there were 4 or 5 of those. None of those qualified because you were blocked at the entity level because of that limitation on liability. Well, that changed under the OBBBA. So if you had a farm entity that experienced a single highly profitable year across an income ceiling, the entire operation faced absolute disqualification from receiving safety net payments, which ended up penalizing all these owners that owned that entity. Now, the OBBBA changed all of that, substantially altered that dynamic because it ignores now the business entity's consolidated earnings and it evaluates the income threshold strictly at the individual owner level. So that's the case for every type of entity except a C corporation. We're going to look through the entity to see if the individual owners in the entity can meet an AGI test, and if so, then they're eligible for payments. That's a big potential boost to cash flow for farming operations.
So let's do this. Can you give us an example of how that works in practice?
Yeah, sure. Let's say we've got an LLC that's comprised of 3 equal partners, and they get a potential $120,000 commodity payment. Now, under the old rules, you would just have one determination made at the entity level with respect to the $120,000. But now, if one owner individually exceeds the AGI limitation while the other 2 qualify, then under the old rules, the entire benefit could be lost. It might be blocked in that situation. But under the One Big Beautiful Bill Act, that entity effectively receives 3 separate payment limit evaluations, not just one. So the entity loses the pro rata share of the third partner here who exceeded the limit, but the other 2 are still eligible. So the operation gets to retain about 2/3 of the payment. And so the qualifying partners are no longer structurally punished. That's a big deal.
Well, that sounds like it's pretty favorable too. But you also issued a warning about ownership splits as well. So why do producers need to audit those structures right now?
Yeah, I had mentioned just kind of in passing as we were talking the AGI limitation, and that's a big deal because the ownership percentages now dictate the exact scale of what I would call payment vulnerability. And so if you have a majority stakeholder that holds the lion's shares of the equity that breaks the individual income limit, then the operation is going to lose the vast majority of its payout. So what we are telling farming operations, and I'm doing this at our seminars, we got into this in quite a bit of detail in the West Virginia seminar a couple of weeks ago, Greg, and we went through a lot of examples with this, and it generated a number of questions from practitioners. And what we're telling the CPAs and the attorneys is you have to carefully audit and plan your client's ownership structures before the upcoming crop year to optimize the safety net eligibility. And any restructuring that they undertake to maximize payments has to be coordinated with their client's estate and succession plan. So if I'm going to alter my ownership percentage solely to increase program benefits, which I can do now, that can create unintended gift tax consequences, and that can affect future basis adjustments, and that can disrupt long-term transition planning. So there's a whole lot of things now that practitioners have to think about. Farmers need to be talking to their planners proactively now to make sure you have all of these things considered.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us and going over some of the things that he talked about, how compressed operating margins are and high interest rates, and forcing families to reevaluate their business structures, but also looking at some of the things they may do now under the OBBBA landscape. So, Roger, one of the things you discussed is something called the 4-layer transparency limit for farm program payments, as operations use stacked companies or complex trusts for asset protection and succession planning. So what statutory barrier do they need to look at then?
Well, what people need to understand is that when FSA distributes program dollars, they look through they use tracing rules to trace the funds through corporate structures until they find living people behind the business. But federal law, now this is statutory, it has an absolute barrier to that tracing. So tracking terminates precisely after 4 distinct levels of ownership. So, for example, if I have level 1 as the primary farm entity, and then level 2 is a corporate holding company, and level 3 is a family limited partnership, and then level 4 is a family trust. And we can get into this when you get really complex estate planning with larger operations in particular. But the point is, if a living human doesn't surface by that fourth layer, then attribution ceases. It's gone. That payment is just lost.
But what's the penalty for that? Restate that mechanical penalty if that human doesn't service by level 4.
Yeah. Now, they didn't do anything wrong. All that structuring is correct, but the penalty is they lose the payment. It just vanishes. That reduction is not driven by regulatory violation. It's not driven by noncompliance with the FSA rules. It's just a mechanical penalty resulting from excessive layers and paperwork. So what I would say here is anybody listening that has an operation where they've utilized group companies, they're going to have to carefully map their ownership chains to make sure that human beneficiaries surface before you get to that 4th level.
Well, let's talk as well about on tax deadlines as well. Many farmers are looking to consolidate capital by selling off underutilized machinery or things like that. But you noted that creates significant uncertainty regarding quarterly estimated tax exceptions. So what's the confusion on that?
Yeah, this can be really confusing. Let me try to boil this down as easily as possible. But traditionally, qualified farmers enjoy an administrative exception here that's really helpful for farmers. If they derive at least 2/3 of their gross income from farming, then they can bypass filing estimated taxes, and they can make a single estimated payment in January or file and pay by March 1st, and there's 0 underpayment penalties if they do that. That's why we tend to think of March 1 as a deadline. It's not really a deadline, but it's a filing possibility for farmers if they meet that test. Well, clearing that hurdle requires precise classification of revenue. So if a farmer sells the equipment, then the gain generated from that equipment sale is frequently substantial because, as I said earlier, a lot of farmers are taking vast amounts of depreciation. They might take 100% bonus depreciation. They may take the enhanced 179 depreciation. And so they've wiped out their basis on that. They've got a lot of gain. Well, that gain's got to be categorized. If that counts as gross income from farming, it helps them clear that 2/3 threshold. If it's excluded, then a significant machinery sale can inadvertently expose a producer to retroactive underpayment penalties.
And that sounds like that means then for the IRS, they left producers in some gray areas on this as well?
Yeah, here's the catch right now. Now, the IRS internal posture on this has fluctuated considerably. And in the most recent revision of the Farmer's Tax Guide, that's Pub 225, IRS quietly removed the explicit written narrative that they had in there that authorized the inclusion of equipment sales in farm gross income. Now, they left an active, unrevised computational example in the Pub 225 that continues to count equipment sales toward the farm income total. That internal contradiction leaves us in somewhat of a gray area, making early consultation with your tax specialist pretty important before you're relying on machinery sales to defer estimated tax dollars. So I'd say anybody that has had a big machinery sale this year or is considering having a machinery sale later this year, better talk to your tax preparer. Give me a call. I'll go over this with you because we've got some uncertainty as to how this is going to be treated for purposes of the 2/3 test and estimated taxes.
Roger, as we wrap this up, some ag economists are forecasting a challenging environment ahead with compressed margins and elevated interest rates as well. But you believe modern producers have the tools available that weren't around during previous downturns as well, like the 1980s farm crisis. We'll use that as an example. So what should they focus on?
Yeah, this was a piece that came out last week by economists at Texas A&M, and I really kind of take offense at it because I think it misses the mark incredibly because it's not factoring in the OBBBA changes, the tax changes and the planning things that farmers and ranchers, the tools they have available to them now. And I have a longer commentary on my personal website, which is rogermceowen.com, on this. I did put a little bit of that in this piece that's on my blog that I posted yesterday. But we're not in the 1980s anymore. And the tax and the ag law landscape in terms of the rules that are available are much more favorable to farmers than they were 40 years ago. And chief among those defenses is the OBBBA's permanent restoration of 100% first-year bonus depreciation. So I get to write off immediately 100% of the purchase price of my major capital assets like specialized machinery, grain storage facilities, and I can combine that with flexible planning strategies. I can use deferred payment contracts to shift my grain or livestock revenue from one year to the next. I can use farm income averaging to smooth out the tax brackets over the preceding 3 years. And I can use installment sales provisions under 453. There's a new provision under 1062, which I wrote, that's in the OBBBA that allows the gain on the sale of farmland to another farmer that's going to farm it for 10 years to be paid in 4 equal installments over basically 4 years. So there are a lot of tools that farmers have available to them now.
Yeah, and you talk about that farmland sales. That's a brand new provision?
Yeah, that is. I was asked by Senator McConnell's office a year ago, this time a year ago, to write that provision, and they wanted a complete exclusion of gain. It didn't come out that way. It was revised after I wrote it, but it allows you to spread the gain on the sale of farm real estate if you meet all the provisions of the code section. You can pay it in 4 equal installments.
Another big piece of advice here, talk with your tax preparer, call you, or call someone that you trust in these issues as well.
Yeah, there's so many planning opportunities for farmers now that they didn't have 4 decades ago. It makes the importance of being proactive on your plan more important than ever. And now you've got to tie in the very favorable changes in the commodity title of OBBBA dealing with all these FSA changes. So there's a lot of things to think about, and farmers need to be proactive. You can't sit back because the landscape has changed now, and there's a lot of things you can take advantage of to improve your bottom line.
Yeah, especially with several things coming up with FSA, and then we're almost halfway through the year as well. Right. 27's not that far away.
That's exactly right. Time flies.
All right. Now, if they want to read this blog article itself, they can go to your blog, then go to your website as well.
So on my blog, it'll be posted on Ag Manager today over at K-State. The more in-depth piece with respect to my complete response to the Texas A&M Ag Economist is on my personal website on the commentary page. That's rogermceowen.com.
And it's good reading, to say the least, good reading on what Roger thought as well. All right, Roger, we're out of time, but as always, appreciate it. Thanks.
Thank you, Greg.
That is Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he has been our guest on the Ag Issues program this morning here on 580 WIBW.